Hey guys, it's Trevor. In this video, I will begin by explaining what the MACD indicator represents, and then I will explain how it is used by traders to identify reversals of a trend. You will also learn a simple but very effective way of how to use the MACD indicator with price action in MT4 and any other software. The MACD techniques explained in this video can be used in any market. However, they work best for Forex or stock trading. Be sure to watch till the end of this video because I will share an important bonus tip with you later on in the video. MACD is one of the most popular indicators for Forex and stock trading. It is a momentum indicator that shows the relationship between two moving averages. MACD stands for Moving Average Convergence Divergence. A major reason traders are using MACD is to calculate divergence related to the price action in the market, which helps signal a trend reversal. It is an oscillator indicator like other common indicators such as RSI or stochastics. Oscillators are tools that construct high and low bands between two values and then build a trend signal that fluctuates within these bounds. They are momentum indicators that typically fluctuate within a higher value and lower value that are derived from the price action of a market. For this video, we will just focus on the MACD oscillator indicator. When used along with price action analysis, the MACD can be a very powerful tool, particularly when swing trading, because it can indicate when trends are slowing down or speeding up. In MT4, you can find this indicator located here. To change these settings, right-click in the indicator window and click Properties. From here, we can see the Input tab, which is where the settings for the MACD moving averages are located. I will explain each of these settings later in the video. The other tab you may want to edit is the Levels tab, where you can set a horizontal level on the indicator to get a clearer view of the MACD baseline. However, I think it is not necessary. I would not bother with the other tabs unless you want to change the colors of your MACD. The MACD default settings are the settings that I recommend using, as most traders are analyzing the MACD based on these settings. As you can see, usually there will be three numbers that are used as the default settings for MACD and MT4, which are 12, 26, and 9. The first number, which is 12, shows the number of periods used to calculate the faster moving average, and the second number, which is 26, shows the number of periods used for the slower moving average. The third number, which is 9, is the number of bars used to calculate the moving average of the difference between the faster and slower moving averages. This difference is plotted by the vertical lines you see, which is called the histogram. Many people think the histogram is a moving average when actually it is the difference between the two moving averages. As you can see on the screen, we have the MACD with 12, 26, and 9. However, when I change the 12 to 4, the histogram becomes more choppy. If I now change the number of periods used for the slower moving average from 26 to 6, then you can see the histogram smooths out because the difference between the two moving averages is less. The reason why it's called MACD divergence is because the faster moving average is moving away or diverging from the slower moving average. If the opposite is happening, where the faster moving average is getting closer to the slower moving average, then this is called convergence, and the histogram smooths out. This is how you get the name moving average convergence divergence. The default settings for MACD use exponential moving averages. There are two commonly used moving averages by traders. The first is called the exponential moving average, and the other one is called the simple moving average. The difference between exponential and simple moving averages is the following. The exponential moving average places greater significance on the recent price changes compared to a simple moving average. This is because the simple moving average applies equal weight to all the price changes within the calculation period. Okay, great. So now that you understand what MACD represents, I will now show you how you can use MACD to help you when trading. From now on, I may refer to the exponential moving average as EMA, now that you understand what it is. Generally, MACD indicators are commonly used in one of two ways, either by crossovers or for signaling divergence in the market. First, I will explain crossovers, and then I will explain how to use it for divergence. Crossover sell signals are generated when the MACD signal line crosses below the baseline, and a buy signal is generated when the MACD signal line crosses above baseline, as shown here on the chart. The speed of the crossover is also considered by traders as a signal to see if the market is heavily overbought or oversold. Take a look at the example in this chart. Another common technique used to identify a crossover is by looking at each of the exponential moving averages. MACD has a positive value when the 12-period EMA, which is shown here by this red line, is above the 26-period EMA, shown here by this blue line. A negative value is simply the opposite of this. Therefore, it is shown when the 12-period EMA is below the 26-period EMA. As there is a faster moving average and a slower moving average, the faster one will obviously react faster to the price movements compared to the slower one. This results in a moving average crossover, which in this example resulted in a reversal of the trend. Out of the two different ways to look for a crossover signal, I prefer using the first one, where we looked for the signal line to cross above or below the baseline of the MACD. The simple reason is that it just uses fewer lines, and therefore reduces the clutter on your charts while giving a similar result. You may also have noticed that as the crossover occurred, the histogram temporarily disappeared because the difference between the fast-moving average and slow-moving average at this point is 0. The more distant the MACD histogram is above or below the baseline as shown here on the indicator, then the greater the distance between the two EMAs is growing. When the histogram crosses over to the other side, it gives another indication of a potential trend reversal. Let's now take a look at how to use the histogram to identify divergence. Divergence occurs when the trend of the price does not align with that of the indicator. In other words, an indicator trends in one direction while the price goes in the opposite direction. Divergence in a downtrend can be seen as price makes lower swing lows, and the MACD histogram is ascending when you connect the lower swing lows, as you can see from the chart. If the MACD histogram is descending, then this means the opposite, which is that the trend is not slowing down, as you can see from this example. It is important to align the MACD histogram with lower swing lows, as shown in the examples. Regular divergence in an uptrend is simply the opposite of what we just did for the downtrend example. We connect the higher highs, and if the MACD histogram is descending, then we can see the divergence. Take a look at the example. There must be an ascending or descending angle for divergence. If the MACD histogram is flat, then this means there is no divergence. Greater importance should be placed on the divergence signal if the price makes a new swing high or low while this pattern continues. Take a look at this example of a continuation of divergence. As price continued to form another swing high, we still have divergence since the previous swing high, therefore it carried on diverging. This adds further weight to the divergence signal, and many traders will take more notice if this occurs. If you feel the need to rewind the video or pause the video, then go ahead, as there was quite a lot of technical information we just covered there in a relatively small amount of time. Okay, so now regarding time frames, there is no such best time frame. However, when starting out to learn trading, I recommend looking for these MACD signals on the monthly, weekly, and daily time frames. The higher time frames carry more weight, and it is easier for beginners to take their time when analyzing a chart when compared to intraday trading. Be aware that MACD has some disadvantages as well as advantages. A disadvantage of using MACD is that moving averages lag behind price like other price-derived indicators out there. This is why, if you are a beginner, I recommend combining divergence along with price action such as support or resistance levels to help identify stronger signals. If you rely only based on MACD divergence for an entry in the market, then you may often find you will get false positive divergence. A false positive divergence scenario means that the price moved sideways or ended up stuck in a range. For this reason, just like moving averages, which are also lagging indicators, the MACD indicator works best in trending markets. I will now give you a bonus tip for using the MACD indicator, as I said at the beginning of this video. The bonus tip is to connect the highs or low swings that are at the most extreme endpoints on your chart when looking for divergence. Take a look to see what I mean from this example. The reason for this is because most of the time it helps filter out many of the very small and far less significant swings, which can often give a misleading representation of divergence. Take a look at this pound versus US dollar chart, and we can see there are many swings we could use. However, the most recent extreme swing high is this one. Take a look at this other example on the pound versus the US dollar, and pause the video if you want to spot the most recent and extreme swing which indicates divergence on this chart. It was this swing here. By identifying the more extreme swing highs or lows to draw divergence, it makes it simpler and easier to be consistent when starting off with using MACD divergence. This tip will help you avoid drawing divergence from recent very small and less significant swings, like this very small swing low on the pound versus the US dollar, for example. Most of the time, if the MACD histogram is showing divergence, the extreme swings like this one will be far greater in size in comparison and hold greater significance in terms of the overall trend divergence. If you are interested in learning more about divergence or other trading-related topics, then make sure you subscribe to the channel. Also, click the bell icon and click the like button if you enjoyed this video. Leave a comment, and I will do my best to reply to everyone. Until next time.